This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Today, we explore the caution signs in today's economy, from the volatility in the AI sector to historically low corporate bond spreads and high price-to-sales ratios. We then shift our focus to the Nebraska agricultural landscape, where we discuss the mixed outlook for farmers and ranchers, highlighting how proactive planning is essential to navigate these varying market conditions. David, I do want to get to these stories about the ag sector in Nebraska, but first, let's do a rapid fire of some more items you were sharing with the team about various indicators. The first one is about AI sales, and they're struggling in many places.
Yeah, so the reason I sent this around real quick and sent a chart out, it was a company called C3 AI. They're smaller relative to the larger landscape of AI companies, smaller company, but they've got some significant value, publicly traded. They reported their earnings this week and actually beat their earnings, but the CEO talked about the sales were not keeping up with what they thought they would be for the implementation of their services, and the stock got whacked by over 30% in a day. And so the reason I bring this up is the cautionary tale of I've been doing this a long time. I was in this professionally when we went through the .com debacle, if you will, and that was almost really more of a telecommunications debacle. It was all the communications companies, the .com companies that went and got their valuations cut sometimes by 30% in a single day. So if you have been riding this wave, that kudos to you. You've made some great money, but just make sure you're taking caution and understand the amount of risk that you may have currently in your portfolio, because single day cuts of 30% in a stock, a prominent stock in the leading sector, should be a shot across the bow, a little warning sign of, okay, maybe we don't have the productivity coming yet from all these data centers, et cetera, that are being built, et cetera. We're spending 1/3 of GDP. I talked about last week, Chip, 1/3 of GDP year to date has just been what we call CapEx, capital expenditures, to build the infrastructure that will one day turn into productivity, but it is not yet there. And when will the productivity come to fruition? I don't know. In the .com era, we spent all the money on upgrading websites and everything going digital and going to web-based consumer stuff. We got the productivity on average in 2006. So it took 7 years to realize the productivity gains from the newer technologies. I don't think AI will take that long, but it certainly might take 2 years.
But we're still in that transition phase.
Yes. And so the risk there is if we don't get the numbers that we're paying these lofty prices for on the stock market, then maybe we have to revalue the prices of these things, and that could be painful in your current portfolio if you're taking too much risk.
Next topic, corporate bond spreads. You sent the team a chart showing they're at historically low levels. What is a corporate bond spread, and what does this mean?
Okay, so we pay attention to the spread, what we're paying for different types of bonds. So the safest bond is going to be issued by the U.S. government, right? Because if the government fails, we've got bigger problems, right? So U.S. treasuries are the safest. So you get the lowest yield, right? Because it's the safest investment. So then typically we see about 150 to 200 basis point, 1.5% to 2% more interest. So if the 10-year right now is paying 4%, for instance, Chip, then if you're going to buy a corporate bond, you would expect to get around 6%. In other words, you're taking a little risk now. It's a private company versus the U.S. government, so you get paid a little bit more for your investment buying the bond. And then high yield will be another 250 basis points higher than that. Well, we've seen the spreads collapse. So right now, corporate bonds and U.S. treasuries are basically paying roughly the same, a very thin spread. When that occurs historically, and that's what the chart that we're showing for the YouTube viewers, that is usually a bad sign. In other words, no one is willing to take on the risk to buy corporate debt and the yields are just fading there, or the government is overspending and you're not getting it's not as safe. So if it's no safer than the corporate bond, why are you buying it if you're getting a slightly less yield? So this is a precursor and usually tells us that a recession is right around the corner. And if you look historically on the chart, when the spreads thinned down, what occurred right after that? Well, we've typically had some significant pullbacks in the market if you go look historically. So it's just another one of those shots across the bow saying, hey, something is not right in the economy.
So the spread is closing because the government bond is no longer the gold standard in the bond.
Either the investors say
that's not
riskier.
Right. That's what's happening.
We're not either willing to buy corporate debt. So there's two ways to look at this. Either the government's is a riskier investment than it was, or corporations, we don't trust you, and so we're not going to buy it. We're just people are not going to give. And if corporations can't get funding, then they can't grow, and then our economy can't grow. Both are bad scenarios.
All right, the corporate bond spread is at a historic low. Next item you sent the team. The price to sales ratio on the S&P 500 is at a historic all-time high. What does that tell us?
All right, so we're willing. How many times sales? So we talk about price to earnings ratio. Sometimes that's called a PE ratio. So how much do the companies earn? And there's a multiple. So the S&P 500 is estimated to earn around $285, $290 over the next 12 months. If we collectively put all 500 companies as one, and historically the multiple is around 17. We're trading around 22.5 times that number. So that's rich on the earnings side. This is another way to value the market: price to sales ratio. And we've never gone up here past 3%. We briefly did this a few years ago and quickly corrected because that is historically high. So right now we're over 3.15% price to sales ratio, all-time highs. That has to correct as well back to the mean. And so typically we're going to say price to sales is usually just over 1 to 1.5% or 1.5 times. So again, another cautionary tale. How overvalued are stocks currently? Well, again, irrational exuberance, 1996, famous speech by Alan Greenspan. Well, the market ripped double-digit returns for 3 more consecutive years, so I'm not saying it has to stop here, but if you're walking into retirement, are you willing to bet your whole portfolio with that much risk? Make sure you understand the risk you're taking. That's the theme of today's show.
In the time we have left, we are going to go through a run of stories about Nebraska and the ag sector. Is it up? Is it down? Maybe certain sectors are up, certain sectors are down. We begin with an item you sent the team about farmland by state. Yeah, I always knew we were an ag state, but Nebraska is actually number 1 in farmland per acre.
Yeah, that surprised me too. And I sent that to the team. I knew it would be a top 5 or 10 for sure, but I didn't realize, just because I think of the sand hills, I don't think as much farmland, right? The topography changes in the western parts and the bluffs, but farmland per acre, we have more than any other state. That was 90%. Pretty interesting. Yeah, 90% of our land in Nebraska is considered farmland. So, hey, we are number 1. We've given a lot of great data here in the last couple of weeks. We rank really well here. So, however, though, in the ag sector, I know what you're going to hit me with next, right, is, well, some of those farmers may not be doing so well this year compared to other years.
Well, and the federal government says so as well. Feds say, this is from the Nebraska Examiner, Feds say Nebraska GDP shrunk more than 6% in early 2025, and it's because of the hit to the agriculture sector. Actually, Nebraska and Iowa, according to the federal government, 6.1% decrease in GDP. Now, a state official in the same story says, well, if you look at the quarter-over-quarter comparison, we're down 1.5%. Are we comparing apples and oranges here, or what? How do you see it?
That's exactly what it is. So 1.5% quarter drop. That if you annualize, if that rate continues, then that would be 6%. Okay, so that's how they're getting the 6%. Okay. And again, it's more sensationalization. There's a lot of folks in the media that are not fans of the current administration. We know that, so they're going to pigeonhole this or push the story in a negative light. The reality is, absolutely, our farmers, the prices they're getting for the commodities we're producing, corn is really not doing well, right? And when corn's selling for only a little over $3 a bushel, our farmers are not making a lot of cash, right? And so that is of great concern. However, since both those articles were printed, and we've had Don Bacon out there kind of talking now, Bacon is free to talk a little differently now that we know he's not running for this seat anyway. We talk about he might be running for something else, but
Omaha World Herald interviewed him. Don Bacon concerned President Trump's tariffs now weighing on economy of Nebraska and nation. Yeah.
Deb Fisher, who was cited in one of those articles as well, whose family is ranchers, etc. Has a little different take, a little bit more positive spin on it. I will tell you, since any of those were printed though, and you sent them to me, they're going to be in the show. Trump was just on the air this week talking about soybeans in particular, which we have a lot of soybeans grown right here in Iowa and Nebraska as well, and negotiating deals as part of these trade deals. And he's told the farmers, hey, give me some time. And I think they will give him time, but you're absolutely correct. This would be a concern if we don't have a deal before we get to the fourth quarter, right? Harvesting comes around, and these guys got to know what their commodities are going to be sold for. And of course, that's why farmers, larger operations, have hedging operations in place. You can hedge these prices. So I started my career as hedging, right? So with commodities and options, et cetera. So to our farmers out there, listen, if you're not sure, depending on the size of your operation, you need help getting a hold of somebody to help you hedge, we can make referrals. We don't do the hedging for farmers, by the way, here, but we have contacts that do just that.
Well, a farmer is a businessman who I suppose is like you. You've often said, at least give me some stable ground rules.
Yeah, we need to know the runway. What's the rules of the game I'm playing in?
Parameters in which I'm operating.
And that's the scary thing is the farmers, do all the work, plant in the ground, and then they have to wait, the season 6-8 months later before they reap the benefits of their crop. And then what are the prices, which is why you hedge.
Well, I'll just quickly note, you sent me something from Freedom Press, Nebraska Cattle Surge, a new era, that on the cattle ranches, things are actually looking pretty good. There's been a lot of rain. The pastures are in good shape.
Well,
so the herds are expanding.
Flipping the script the other way, cattle is very profitable now, and we're getting great prices for cows. And so many ranchers are expanding. We have several clients that run herds and are expanding their herds right now. And that's the right thing to do because there is going to be, there's a demand for good Nebraska grown red meat, right? And that's what we eat in my household. So I think this is fantastic. So again, the farmers, depending on what business you're in, ag or livestock, different picture right now.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.